Welcome to the Capital News. I'm your host, Alex Karitis. Today is Wednesday, April 7th, 2021. Thank you so much for joining me. Hope you're all doing well out there today. Title of today's podcast, Uncle Sam's Debt is Junk. Yesterday's podcast was U.S. Taxpayers Bail Out the World, and we were talking about a whole host of issues. A lot about the $650 billion that our Treasury Secretary Janet Dingbat Yellen has authorized to the International Monetary Fund, the IMF. Of course, she did not need the approval or the consent of the United States Congress. So she just says, a lot of countries, poor and middle-income countries, are on the verge of basically going bankrupt. They're going to default on their debt obligations. We can't have any of these shenanigans. They can see the writing on the wall, too. I'm not the only one with a crystal ball. I don't have a crystal ball. I am just observing what's going on in the real world and connecting the dots and trying to paint the most vivid picture that I can for myself and for this audience so we can have a good back and forth discussion and debate about what's taking place. I don't want to focus on all of the cultural war issues, as concerning as they are. I don't think that's the big prize. It's all of the money that they are stealing from us right in front of our faces, abusing their power, their authority, right in front of our faces, and they don't give a damn. And they don't give a damn because they don't care about us. They don't care about us for a second. I told you there was going to be so many 1-2 punches, double whammies, between our now Treasury Secretary Janet Yellen and our current Fed Chair Jerome Powell. Back and forth, back and forth. It's going to be a hit from the fiscal side with Janet Yellen. It's going to be a hit from the monetary side from Jay Powell and company. The Biden administration has only been in office for a couple of months, a few months here. They are just getting started. They are just getting warmed up. And this is the stuff that they can get away with through executive orders or through the powers that they have or they think they have, or they're just going to do it and they're just going to flaunt it in our faces. And you still got Chucky Schumer and Nancy Pelosi up on the Hill that just want to cram as much legislation down our throats as humanly possible, to the tunes of trillions and trillions of dollars that we do not have. Nobody's stopping any of this nonsense. But yesterday I noted that I wanted to talk about how Uncle Sam's debt is junk, and how I don't say that during my market performance updates to be a funny guy, to be a wise guy. I say it because it is junk. It's garbage. Nobody wants it. The only institution that wants it is the Federal Reserve. And this is pretty much the same song and dance for every other country around the globe as well. It's what the Bank of Japan is doing. They buy their own Japanese government bonds. It's what the ECB is doing. They're buying European bonds. It's what the Chinese are doing. It's what the Australians are doing. It's what the Canadians are doing. It is a central banker's world. It is their paradise. They're buying everything. They're just printing the money and they're going out and they're buying real assets that pay a yield, that pay a dividend. And depending on the central bank, some of them go out, like the Bank of Japan, they go out and they buy Japanese ETFs. Or the Swiss National Bank goes out and actually buys stocks outright. And not just on the Swiss exchange, but they're huge holders of U.S. stocks, U.S. tech companies. Ain't that grand? They can counterfeit money, because that's what they're doing. They're printing money. You go do it and see what you're called. You'll be called a counterfeiter. They'll lock you up and throw away the key. And then they take that funny money that they've just conjured up, they've printed it out of thin air, and then they go buy real assets with it. They get the share price appreciation, they get the dividends, they get the special dividends, they get whatever's being paid out. They get it. And nobody questions any of this. And in fact, a lot of these central bankers get applauded. Pats on the back. They're the saviors of the economy. Without these people, where would we be? This is like Stockholm Syndrome, where the kidnapper or the kidnapped gets, sort of falls in love or goes to the defense of their kidnapper. That's what this is. They break our legs, and then they give us crutches and say, look, without us, you couldn't walk. You wouldn't be able to stand up. They broke our legs. They do it day in and day out. How much more evidence do we need to see? They know they're trapped too, by the way. So what has taken place with this $650 billion gift from the U.S. taxpayer to these other countries, this is the fiscal response that would be analogous to what the Federal Reserve did with their currency swaps last year that we discussed. And I brought that up recently too, because the recent rise in the U.S. dollar, perhaps creating, or perhaps we might find ourselves in a dollar doom loop system, or cycle, if you will, if this continues. Because last year, there was pandemonium, lockdowns, restrictions, supply chains were completely just shut down. And obviously you had massive sell-offs in the broader markets. Okay, that's understood. But in that, you had a lot of other countries that had a lot of demand for U.S. dollars. They have debts that need to be paid in U.S. dollars. They need to build up their reserves in U.S. dollars. They don't have the printing press that prints U.S. dollars. The Federal Reserve does. So in order for these other countries to get their hands on dollars, they would have had to have sold off their treasury holdings. You sell your treasuries, you get the dollars. Well, if you sell these treasuries, price go down, yields go up. The exact opposite of what the Federal Reserve wanted to happen. They didn't want borrowing costs to spike, to go up. They wanted them to go down as low as possible, zero bound, where we still are. So they said, wait, don't sell them. We will enter an agreement with you, currency swap situation. You can use those treasuries as collateral. If something else gets worse, okay, then we'll deal with it. But right now, just hang on to them. Please don't sell the treasuries. So this is akin to that scenario. But now it's on the fiscal side, if you will, with Janet Yellen authorizing $650 billion to go to the IMF, because these countries are on the verge of defaulting on their debts. And a lot of their debts are U.S. dollar denominated. And again, they're U.S. dollar denominated because a lot of investors don't want to touch poor countries' currencies. They don't want to have that currency risk associated with their investments, with their portfolios. Very understandable. So these countries, they say, wait. Okay, we understand that we're not a well-diversified economy. We understand that, they're obviously not going to admit this, but they understand that there's corruption and this, that, and the other that goes on at the highest levels of their respective governments. And they say, okay, you have enough risks as it is. Let's try to do our best to remove the currency risk, and we will issue our debt in U.S. dollars. So that, allays some of those fears and concerns with respect to currency risk. And then they go out and they buy the bonds. They purchase the bonds. Well, given everything that's taken place because of the lockdowns, restrictions, commodity prices for energy obviously going down because of no demand. Of course, we're seeing a little bit of reversal on that, and we'll continue to monitor that closely. But because that tends to be the lifeblood of a lot of these poor nations, oil, natural gas, what have you, they are not generating enough cash flow to sustain themselves, which is why they're on the verge of defaulting on their bonds and their debt obligations. This is very easy to see. This is very easy to understand. This is not a black swan. This is not something that is coming out of nowhere. Very foreseeable. But again, instead of allowing the market forces to liquidate these debts, to allow restructuring, we say, no, we're going to bail you out as well. It's one thing for the U.S. government to bail out U.S. citizens, U.S. corporations, etc., which I'm totally against, but at least it's here in the country for the American people. This is $650 billion U.S. taxpayer dollars to go to people around the world. This is beyond ridiculous, but it is not surprising. It's criminal as far as I'm concerned, but this is what we're doing. And of course, our government is very afraid of an increase in political and social tensions. They are concerned about the riots and the protests and coups and wars, civil wars, what have you. They understand this too. It's not that difficult to connect the dots. So I just want you to understand that that's what we're doing. The U.S. taxpayer continues to bail out everybody else. So I hope you're happy about that. And this cuts across party lines because this was bound to happen because nobody has a spine to stand up to any of these people in power. And it's the same people. Janet Yellen's been around the block. Jay Powell has been around the block. Ben Bernanke. All of these people have been around the block. It's a revolving door in Washington, D.C. between the powers of government and the halls of our largest corporations. You understand the game. You understand why they do this. They're not looking out for you. This system is a joke. And they're trapped. And they know it. And they know they're running a Ponzi scheme. That's all this is. I mean, my God, we talked about this before too. Bernie Madoff would still be in business if it wasn't for the great financial crisis. People were losing money in other accounts. And they said, Bernie, you, all these great returns you've given me, I need some of that money. Well, guess what? He didn't have it. That's a Ponzi scheme. Government doesn't have the money either. That's why they're printing it. So if Uncle Bernie had a printing press or the GFC didn't happen, he'd still be in business. Our government, our Ponzi scheme, is still in business because we do have a printing press and we still have a lot of suckers in this country that obviously continue to pay taxes. Bernie didn't have that. Uncle Sam does. But that does not mean that Uncle Sam's debt is not junk, because it is junk. So we have the Federal Reserve. Their minutes came out from last month's meeting. Fed officials generally viewed the recent rise in Treasury yields as a reflection of the improved economic outlook and higher inflation expectations. The Fed also noted that asset purchases would continue at least at the current pace until substantial further progress toward maximum employment and price stability goals is made. So again, their narrative is, as we look at Uncle Sam's 10-year junk note, so long as those yields are increasing, their story is that's indicative of an improved economic outlook and higher inflation expectations. Yet they want to keep the pedal to the metal with their current level of asset purchases, their quantitative easing, $120 billion a month, at least $120 billion a month. And that's a combination of treasuries and mortgage-backed securities. And of course, if they want to, they can dabble in some other things too. Corporate debt, this, that, and the other. But the bulk of it is treasuries and mortgage-backed securities. And of course, the mortgage-backed securities piece of the puzzle is somewhat of a head-scratcher because they've been doing this for the past 13 years since the GFC. They said it was going to be temporary. This thing is a teenager. It's about to get a driver's license. And during the GFC, you had housing prices plummeting. Now we have housing prices at all-time highs. Yet they continue to engage in an emergency facility, in an emergency operation, quantitative easing. Why can't a journalist ask these basic questions? Why do you continue to do this? How can this be justified? And the reason they continue to do it, ladies and gentlemen, is because we are still feeling the effects of the great financial crisis. That's why they're continuing to do this. And it allows them to continue to buy more assets. They can just buy everything up. And nobody pushes back, nobody says a thing, because as long as stocks keep going up, as long as people's accounts keep going up, they don't care what this is doing to the country. They really don't care what it's doing to the rest of the world either, because the inflation that we are creating doesn't just stay within our borders. It's an international man of mystery. It has a passport to every country. It goes everywhere. And we are witnessing that in one country after the next. The weakest links are falling or are about to fall and crumble. This $650 billion gift, pat yourself on the back for giving this to other countries. This buys some time. Just like the several trillions of dollars that we have flooded into the system, all that's done has bought us some time. So it's interesting that the Federal Reserve is saying, okay, these higher yields are indicative of an improved economic outlook and higher inflation expectations. However, they want to maintain their asset purchases until we hit maximum employment and price stability goals. Well, one of these things is not like the other, because if they're saying that yields are going up because inflation expectations are looking higher, well, then that shoots your price stability goal out of the water. Price stability is no inflation, no increase in prices. That's price stability. You can have year-over-year change of 0, 1%, 2%, 3%, 4%. Anything above 0 is not stable, or it is less stable than 0. That's solid. Of course, there is no year-over-year change of 0. Not in this country. It ain't going to happen. And in effect, what we are dealing with this $650 billion gift is a first world banana republic assisting third world banana republics. This is a Ponzi scheme. It's coming down. And when it does, it's going to be devastating. Because just like a lot of those people who were investing with Bernie Madoff, they didn't see it coming. And a lot of people lost everything and they couldn't recover. A lot of people do not see what's going on here. They can't connect the dots. They listen to their frat bros on social media, on CNBC, on Bloomberg, on Fox Business, who get up there and say, bye, everything's going up, don't worry about a damn thing. I don't think any of these people are going to tell you when to get out, when to take profits off the table. And if you lose, these people aren't going to send you a birthday card or a Christmas card with a big check in it to make you whole. But people don't care. They don't care what's going on with the country. They don't care if we're losing ourselves as a country. They don't care about the morality or the humanity of it if we lose all of that. As long as their stocks are going up, that's all anybody cares about. Until they don't. And that's why these morons, these idiots, these jokers continue to flood the system, monetarily and fiscally speaking, because that's all they can do to keep inflating this thing bigger and bigger, in the hopes that something miraculous happens, or at least they're no longer in the seat when it all bursts. So I hope you understand that. And if you don't, send me a message and I'll try to come up with some other analogy, because this is very important to understand. We have the U.S. recording the highest trade deficit on record. How timely. We just talked about that yesterday. And a new report came out earlier today. The trade deficit in the U.S. widened for the second month to $71.1 billion in the month of February. Fantastic. And some headlines would argue that this is a sign of growth. We're spending more, we're importing more, that must mean the economy's coming back. No, we're not producing. We're spending the funny money. That ain't growth. That's inflation. That's a joke. And it's extremely expensive. But real quickly, getting back to the Federal Reserve's meeting minutes. So they want to argue that the narrative now is yields increasing is indicative of an improving economic outlook. What happens if yields go back down? Are they going to come out and say, well, the economy is getting weaker again? If they should come out, perhaps because the yields keep going up, are they going to come out and announce yield curve control? Well, why? Why would you want to control the yields? That's indicative of something good. If something good is happening, then why are you trying to control it, to push it down? They're trapped, folks. They're trapped. So it's going to be interesting to see what happens if yields should go back down, because they most definitely could. If they'll say, that must be indicative of the economy recovering, or are they going to come out and admit, no, the economy is losing traction? What are they going to say if that should happen? That's why you got to pay attention to what these idiots say. Reserve Bank of Australia and the Reserve Bank of India have kept their interest rates steady and, of course, remain committed to do whatever it takes to keep their markets afloat as well. Dollar index is at 92.39. Not too much movement in the overnight Forex market. Bitcoin is at $56,500 a coin. Overnight futures trading, the Dow Jones is up about 0.1%. The S&P 500 is up about 0.4%. The NASDAQ 100 is putting on a gain of about 0.6%. Cash trade in Japan is currently down about 0.5%. Mixed bag across the pond in Europe. But nonetheless, the UK exchange put on another gain of about 1%. So getting a little bit of a rally these past couple of days over there in the UK. Australian cash trade putting on a nice gain of about 0.8%, and Chinese stocks are currently up about 0.2%. Nonetheless, it was a choppy session across the board today, equities, commodities, and we have WTI at $59.54 a barrel, Brent $62.92, natural gas $2.51, gold and silver also choppy during the day session. Gold at $1,739 an ounce, silver $25.09 an ounce, and copper is still at about $4.09 a pound. Lumber continues to rally higher, hitting an all-time high. So just when you thought lumber couldn't go any higher, oh, it is making new all-time highs, and that's really going to put a nice dent into people trying to buy a new home, wanting to put on an addition, any type of things, anything really dealing with construction. Some estimates are the average home now for a new build, for the average home costs an additional $24,000. An additional $24,000 just because of the lumber prices. Now, that doesn't take into consideration anything that deals with drywall or copper or any other commodity or construction material that would be needed to construct a new home. But there's no inflation, ladies and gentlemen. There's no inflation. So people look at you and lie to you, and people suck it up. Uncle Sam's 10-year junk note is yielding 1.67%, so it's still hanging on there. And I just want to reread what I read yesterday, a short paragraph from a report from Fitch Ratings, because I thought it was well written, succinct, to the point, and really encapsulates what's going on here, that all of this funny money printing, fiscal policy, monetary policy is just kicking the can down the road. It has only filled a void for a very short period of time. So here it is, diverging bankruptcy trends flag SME risks. SME, small, medium enterprises. SME bankruptcies are set to rise significantly in 2021 and 2022. So we're far from out of the woods, but to lower levels than that after the global financial crisis. The unique nature of the coronavirus crisis with special measures that have suppressed business failures means visibility on how they normalize is poor. Again, that sentence simply means that what the federal government and the Federal Reserve have done have caused distortionary effects and have delayed the inevitable, creating zombie corporation after zombie corporation, which is now about 25% of U.S. businesses can be classified as zombies. A faster than expected surge in SME bankruptcies and non-performing loans could tighten credit conditions, weighing on the recovery. There have been far fewer bankruptcies during the coronavirus crisis compared with previous recessions, particularly among small businesses. Direct financial support and forbearance measures and interruptions of the bankruptcy process due to social distancing restrictions have artificially depressed bankruptcies. Insolvencies will rise as these measures are phased out. The divergence between U.S. Business Chapter 11 and Chapter 7 filings in 2020 suggests a backlog of failures for smaller firms. Chapter 11 filings by corporates increased in contrast to a fall in Chapter 7 commercial liquidations, which tend to be SME-dominated, although large and small firms can use both options. The fall in SME failures in 2020 is at odds with the rise in high-yield bond defaults. SME bankruptcies will rise, potentially significantly, once restrictions, policy support, and forbearance are scaled back. And unfortunately, a lot of these bankruptcies are not just going to be in the corporate sector. This is also going to occur in the individual, the consumer sector as well, if you will. Because all of the forbearance, all of the moratoriums on evictions and rent payments and mortgage payments, etc., that ain't forgiveness. That's forbearance. All of that money is going to be owed. People have not been working. Yes, they've been getting stimulus checks. Yes, they might have been able to get extra money from various PUA or PEUC programs, but that ain't enough. They're not going to be able to pay all of that money back. And what's going to happen? I mean, these landlords, that's their living. These are not all greedy capitalists who are multi-millionaires who are just sitting on the property. These are a lot of small businesses themselves. These are a lot of middle-class individuals, husbands and wives, who say, well, let's buy another house, let's rent it out, let's get a little extra cash, part of their retirement. These people they're not sitting on millions of dollars that can just tolerate their tenants not paying them rent. This is far from over. You want to go spend trillions of dollars, you're going to have a good time. Believe me when I tell you. And that's all it is. It looks good, but the chickens are going to come home to roost. So right now what I'm looking at is the U.S. high yield index effective yield. So if you wanted to look this up on the Federal Reserve economic data, type in high yield index effective yield. Okay? This is your junk bond market, in essence. And then you can graph this against pretty much anything you want to, obviously. But what I'm curious to see here is how this is trending and how this is moving with Uncle Sam's debt. So I have this up against the 10-year U.S. Treasury junk note. I have this against the 2-year, the 5-year, and the 30-year. Now, what gets a lot of attention, at least right now especially, are these longer durations. So the 10-year and the 30-year long bond. And when you look at the high yield market, so the junk bond market, it is currently at a rate of 4.3%. 4.3%. This is data going back to 1997. This is almost an all-time low. The only time it was lower was last month. So we have junk bonds, in essence, in aggregate. Obviously, there are some that are yielding much higher than this, but this is just in aggregate, at 4.3%. And we have Uncle Sam's 10-year junk note at 1.6, 1.7%. See where I'm going with this? You see why I call it junk? Never have these yields, these respective yields. Never has the 10-year exceeded the junk bond market, which shouldn't happen. That, economically speaking, should not happen. All right? But if you look at this, you see the junk bond market, their yields going down, and you have the 10-year yield going up. The spread is tightening. When you understand finance and various types of pricing models, you use the risk-free rate, which is Uncle Sam's debt. And a lot of people will use the 10-year note as their risk-free rate. It's risk-free because the government can tax and the government has access to a printing press. So if you're pricing perhaps the decision as to whether or not you want to invest in a certain project, you'll use this. You'll use the 10-year note or some other risk-free rate along the Treasury curve as sort of a benchmark. Does it make sense to put millions of dollars into a potential investment? Or would we just be better off putting it in government debt? And of course, if you're going to have a higher return, well, then maybe it's worth the risk. But if it's really not that big of a difference, well, then I'm not going to invest in something else. I'm just going to put it in the debt market, Uncle Sam's debt. I think that makes intuitive sense. Now, of course, both of these markets are greatly manipulated. We know the Federal Reserve has conducted emergency operations during COVID-19. That's, of course, their justification to get involved in purchasing corporate debt directly from these companies, so on the primary market and also on the secondary market. So these markets, like everything else, are completely manipulated and completely distorted. But when I say Uncle Sam's junk, or when I say Uncle Sam's debt is junk, this is what I am talking about. These yields are about to converge. If the 10-year note should exceed this junk yield, hell has frozen over. That's basically what this is saying. I don't anticipate that's going to happen, but the fact that the spread is this close, and there have been other times in the past where it's been similarly close, but the fact that this is happening now serves as further evidence of the distortionary effects that exist within these markets. So 4.3%, nearly an all-time low. Junk yields, going back again through 1997, have never been below 5%. For whatever reason, 5% seems to be some level of strong support, if you will, or resistance. It's not going to go through it. 5%. Now we're through it. 4.3%, 4.2% last month. A little bit of context, during the Great Financial Crisis, it peaked over 21%, over 22% during the Great Financial Crisis. We are in the midst of something that, in my mind, is worse than the Great Financial Crisis, and instead, we have junk yields at 4.3%. So you still had some market forces making sense in trying to clear the market out a decade plus ago during the GFC. Now, pretty much all bets are off. It's a central banker's world. It's a central banker's paradise. We're not going to allow this to happen. We're not going to allow markets to properly price risk. We're just not going to let it happen. We, the Federal Reserve, the ECB, other central banks, we're going to step in and we're going to buy all this stuff up. Price goes up, yields go down. That's exactly what's taking place. And because yields are so low, because of these distortionary effects and because of these policies, so many corporations are continuing to binge on this cheap debt. Yet their total amount continues to go higher. So all this means is future growth and prosperity is going to be virtually non-existent, and it's saturated. It's saturated by debt. Because all of these firms are going to have to pay. These are debt obligations. These are contracts. This money has to be paid back, plus interest. So all of that money now has to go to paying off their debt as opposed to reinvestment in the economy, in their businesses, research and development, hiring more people, etc., etc. These are the zombie firms. This is the zombification of the economy. This is the economy of the living dead. What should be happening, very painful, but it needs to take place, is the liquidation of these debts. And it's going to happen. Even Fitch and all the other credit all the other credit rating agencies, for all of their faults, for completely missing the boat during the Great Financial Crisis and being very much a part of the problem, just rubber stamping everything AAA, even though it was junk, they're at least calling this out. They're at least saying, well, we would have expected and anticipated a lot more bankruptcies, and it was bad last year. They still say, yeah, we would have expected a lot more, historically speaking. But that didn't happen because of what Jay Powell and company did, because of what the Trump administration did, and because of what now the Biden administration is doing. But once those things pass, and we imagine at some point they will, well, it's going to be bad in 2021 and in 2022. And I wouldn't be surprised if it goes a little bit further than that too. Because we're talking tens of trillions of dollars here. This is not just going to be wiped out overnight, although anything's possible. So you could do this same exercise with the high yield rates, the junk bonds, against the 10-year, as we just did, against the 30-year, the 5-year, what have you. And of course, for the longer end of the Treasury curve, the 10-year, the 30, that spread is tightening, which just makes the debt of Uncle Sam look much more like debt, much more like junk, I should say. That's why I say this. Now, on the shorter end of the curve, there's still a decent spread, not as close. But if the current trend continues, then we might see a convergence for the first time in history. And I would argue that if these rates do converge, well, then there's no more argument. Maybe somebody can say I'm just saying this tongue-in-cheek, or I am being a wise guy. Oh, he's just saying that to get attention, that Uncle Sam's debt is junk. No, it is. But if these rates converge, then there's not going to be any dispute whatsoever, because anybody can look this stuff up. This is the consequence to what we have done. And I can assure you, when all the chips are on the table and we got to lay our cards down, it ain't going to be corporate America that gets saved next time. And it don't matter what size business, small, medium, large. It's going to be the government that gets saved. The government is not going to go out and try to save everybody else, because they're not going to be able to. They're not even going to be able to save themselves. But when it comes down to it, that's who they will attempt to save, the government. That's who the Federal Reserve will attempt to save, the government. That's where we are headed. That's what this chart is indicating to me. We are on the verge of bankruptcy. Many could make the argument that we're already there. You happy about this? I'm not. I'm not happy about this. I've seen this coming past couple of years. I said this economy wasn't strong. And don't forget that either. This economy was weakening before COVID-19. You get the convenient excuse of a pandemic to blame all of that on COVID-19, lockdowns, restrictions, the unknowns, blah, 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 blah. How convenient. And they justify the unjustifiable on a daily basis. They're getting bolder. They're getting more arrogant by the day. Bring it on, baby, they say. Come on, markets, test us. See what you can do. Bring it on. And nobody says a damn thing. I hope you turn people on to the Capital News as much as possible, and other like-minded podcasts and any other type of presentation that's out there on Apple Podcasts, YouTube, anywhere on the internet, anywhere. Because this country, the global economy is going down, and it is all about control and consolidation in power. The writing is on the wall. These people don't care about us. They don't care about us. Never did. And it's most obvious right now. People need to wake up. We need to demand true and effective change from our government officials. Because if we just continue to let this happen, well, guess what? It's going to continue to happen. We are going to continue this conversation well into the future of both U.S. taxpayers bailing out the world and Uncle Sam's debt being junk. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Koritis. Godspeed.